Hey, good morning, everyone. Marty Mazur here. It is Thursday, the 25th of January, 2024. End of week market snapshot. Clients shall get it linked to an email in the morning as Friday morning's message. Then I'll follow up either later Friday or over the weekend as usual with your economic update. That'll be interesting this week. We got GDP out today for the fourth quarter. I want to parse that for you. It wasn't a ton of data this week, but what there was important. So today I can keep it quick. Pretty much the same patterns are continuing to move in the same direction. So we'll look at that and what they may portend going forward. I do want to touch on breadth and just update what I showed you a couple days ago, and then quickly we'll just look at sentiment as well. Starting with breadth, remember day before yesterday we had 5 sectors in the green of the S&P. Well, as of the close yesterday, we're down to 3 with healthcare. And healthcare is down a pretty good chunk this morning as well, bucking the so far positive trend in the major averages. And industrials have rolled back into the red as well. So again, not the makings of your, what I like to say, all boats rising with the tide, healthy market. In fact, quite the opposite, back kind of to the scenario of last year, which ultimately is not a sustainable scenario. Either leaders are going to have to catch down or the laggards are going to have to catch up. And we think it's a difficult environment for the latter right here. But happy to change our minds as environmental developments evolve over the next few months. So also, remember I showed you along the same lines, a rising S&P and a rolling over S&P equal weight and a strongly rolling over Russell 2000, notably down first month of the year, while the S&P is notably higher. Again, very reminiscent of last year and very reminiscent of some difficult periods of markets past. In terms of sentiment, remember this one we marked up quite a bit over the last couple of years. This is the American Association of Individual Investors widely followed sentiment survey. Comes out weekly, and I pointed to what it looked like heading into 2022, which was, we think, the first leg of the bear market, and which means we don't think it's over. At least that's what our indicators and our studies suggest at the moment anyway. And here it was going into last year, which turned out to be a good year, at least for the major averages that are concentrated in a handful of stocks. So you see how markets tend to go opposite of sentiment. Essentially, you get too much crowding on one side of the boat. Going into last year, very bearish sentiment, turned out to be a good year. Year before, very bullish sentiment, turned out to be a bad year. This year going in, very bullish sentiment. Doesn't mean this has to be a bad year. It just means that going into the year, the boat was crowded, very crowded on the bull side. Still quite the gap between bullishness and bearishness, but definitely with this correction right here, you see how fast investor sentiment or individual investor sentiment can change. And you can see my line here. Here's where it peaked. Here's the market rolling over a bit, but here's the market coming back. It'll be interesting to see if we can hang out in these new all-time highs for very long, if this will come ramping back up. Notice back here we had similar action. We peaked, market rolled over a little further, came back, tested that peak, kind of like it did here, dipped down again, and only in more dramatic fashion, right, based on the look here, then went into all-time highs, and then finally rolled over. Absolutely, unequivocally, doesn't have to play out that way, but it would make sense to us if it did, based on a lot of things, not the least of which being where sentiment sits right now. Speaking of that, widely followed Citigroup Fear Greed Index. We have our own. We don't use this as a component, but it's got many of the same components. It's back into extreme greed as well, which is a caution sign. And then lastly on that topic, I'm just going to pull over our page from Investor Intelligence, and they track advisor sentiment. And in our Fear Greed Index, we use the bull-bear spread. And as you can see right here, the bull-bear spread expanded back up to 35.8, big jump from 29.4 a week ago. That's back into the cautionary initial danger zone above 30. Shown 7 of the last 8 weeks. The peak so far was at 39.9. That was 3 weeks ago. That just missed the 40% action level. They're basically telling you sell stocks, go short, whatever, when it gets above 40%. But again, that 30 to 40 or so is considered a watch yourself level. If you're a short-term trader, we're looking for bigger signals and something that could spark something bigger to the downside. The wider the positive spread, the higher the risk. And here they say with plus 35 to plus 45, it's clearly there. So again, these are just things that suggest that there's some added short-term risk in this market currently. Okay, so on to the technicals. Once again, just because it's up here, here's the hourly chart of the S&P 500. Remember, we were looking at this ascending triangle, and I said that based on the momentum indicators that that would be a bearish look, but we did break out. You can see yesterday we broke out, and then we kind of fell right back in, and we're testing that as support. Gapped up here this morning. As I speak, the S&P is up 31 basis points. It was up easily twice that here a little bit ago, so it's kind of giving up the ghost once again, at least intraday. I noticed volatility, the VIX is up about 2%. As we move into that, right, that now becomes the infamous, rising wedge pattern, or close to it, with bearish divergences. There's a look of caution, not a sell signal by any stretch, but just a look of caution, if you will. On the daily chart, we continue to crawl our way into all-time highs. If you do that, you've got a concerning look. Rolling over to here, you do have a little bit of a buy signal here on the MACD, but you don't have the slope that you're looking for. As I show you, I'm not going to show it to you again. This was the look at the last all-time high. As for QQQ, the ETF that tracks the NASDAQ 100 index, this is what we were looking at yesterday. This is what we're still looking at today, although that's not a divergence, but it's very overbought. You can see coming off of that level a little bit, but now we have, again, that pattern that's typically not a great pattern against bearish divergences. Again, you don't have a sell signal actually till you break down below the uptrend line. So not actionable the way we would look at this for short-term traders. Nevertheless, not a bullish look. It suggests that odds favor a breakdown. And then the Russell 2000, it indeed has struggled. I pointed to our failed bear flag pattern. If you can see it ghosted in there. Yeah, it should have gone to about here, and it didn't. Came up, but I pointed to this very stiff resistance. Today at one point, I'm sure it was up over 1%. It's only up a third of 1% as we speak. So a lot like yesterday, where it was up for a bunch of the day and closed lower. It's kind of what the action looks like today. Nothing really telling or convincing about the momentum indicators down here right now. Looking at all important yields, the bull flag pattern on yields played out to target, right? This would typically be bearish for stocks, at least the way they've been trading, but they have bucked this trend of late. So could have to do with earnings and so on, but ultimately that's a wait. If this were to continue to go, that would be a real wait on equities in this current environment. We do expect, though, that if our economic analysis is correct, yields have a lot lower to go before this is all said and done. But in that context, that wouldn't be bullish for stocks because earnings would have a lot more to go to the downside, or I should say be very disappointing relative to what's currently priced in. And then lastly, the dollar. I drew another consolidation rectangle in here. You wouldn't act on this just yet if you're trading currencies, but you could argue that momentum is waning as we're consolidating here. Right? And, lower dollar, typically, at least the way the markets have been trading, would be bullish for stocks. So something to keep an eye on. So folks, it's a good time to be patient. In our view, it's a good time to stay hedged, stay pretty liquid, be prepared to take advantage of a good sell-off, which could happen in the course of 2024. I think that would be the one to take advantage of, or be prepared to add two positions if the conditions that have us with some defensiveness in our portfolio abate and give us more of a green light going forward. So I would not be myopic. I would not be obsessed with what the market does, the stock market that is, on a day in, day out basis. It's not what we benchmark against, but it is something that we look at for signals. And of course, stocks are a little better than 50% of our core portfolio right now, so it is important to us what's going on there. And I know you viewers are very interested in our technical view of the stock market, which is what we're showing you here, as well as some other things that I think are related to that. Folks, thank you as always for watching and listening. Be back in a day or two with the economic update for you. Take care. Have a great day. Bye-bye.